Welcome to the Debit This, Credit That podcast with Wheeler Accountants located in San Jose, California. In this podcast, we discuss how to solve accounting challenges in both your personal life and your business. We take an energetic, tech-savvy approach to solving accounting challenges that steal your focus and your time. Now, on to the show with your tech-savvy accounting experts, Matt Wheeler and Michael Bryant.
Welcome to episode 27 of the Debit This, Credit That podcast by Wheeler Accountants with your hosts, Matt Wheeler and Michael Bryant. Today we have another guest on the podcast today, an experienced podcaster. How many do you have now, Scott?
20, I think. 22, 23.
So
you guys have passed me up.
So we're on 27, so we have more than you, but you're still quite experienced. Not that we're keeping score. Scott is a registered investment advisor in CFP. He is part of BetterWealth, which is an investment advisory firm upstairs from our office here at 1475 Saratoga Avenue in San Jose. And today we're going to talk a little bit about, Scott's industry a little bit, get some answers from him that I think will be useful for our individual clients on, what they should be thinking about in terms of investment planning and financial planning for retirement, kind of the fees that you end up paying inside of your investment accounts when you're working with someone like Scott, and how his industry works in that respect. And there's a lot of fine print, I guess you could say, and fees can sometimes be hidden and that kind of stuff. And so it's useful for people to know, because I think a lot of times, they're not really seeing how much they're actually paying. And Scott's a big guy, not on performance, but about, planning for the future, making sure your spending is in control, and then really monitoring the expenses on your investments as well, because that eats into the return, especially in the kind of low return environment, the new normal that we're in since the big crash. So welcome, Scott.
Thank you. It's good to be here.
Yeah, great to have you, Scott.
Why don't we start, I guess. There's a lot going on in your industry, and you talk about it fairly often with us, but I think it'd be useful for our clients to hear about the whole regulations that I guess were going to go into place and then ended up getting repealed at the stroke of a pen or something is what I understand. But give us a little background, I guess, on what's going on in your industry.
Yeah, sure. It's a good question and good topic. Essentially, we're talking about the Fiduciary Standard, and there's lots of details and laws and regulations about it, but essentially the easiest way I like to think about it is that the Fiduciary Standard that is your financial advisor, is he required or is she required to put your financial interests first ahead of their own? And although there are lots of good people in the industry, there are some not so good people, just like there are in every industry. And the Fiduciary Standard, I think, is what we're talking about. And you want to work with people who have that role, that official role. In fact, I just went back and got another accreditation. I went and got my AIF, so I'm now an accredited investment fiduciary for clients. And you're going to see that accreditation, just like you see the CFP, I think, more and more and more as time goes by.
Is that a new accreditation?
No, it's a good question. It's been around for about 30 years, actually.
Oh, okay.
But I think as this fiduciary issue becomes much more prominent and much more available for retail investors to look at and understand, you're going to see a lot more people with the AIF certificate, at least.
So we throw around the term fiduciary quite a bit. What exactly does being a fiduciary for your clients mean?
Yeah, so there's actually a specific legal code of what it has to be, and without getting into that, legal gobbledygook, as I call it, essentially it means that I have to always, in every interaction, put the client's financial interests ahead of my financial interests. And that's essentially what it means.
And they put that kind of stuff in place because if we go way back to kind of like the old days, or like you watch like the Boiler Room type movies where guys made money on commissions and trying to sell you stuff or make trades, that was their interest kind of being ahead of the client, obviously.
It was, and it really comes back to another way to think about this is structure versus function, right? And I have a belief, sort of from an engineering perspective, that our structure is actually what dictates the function that we're going to be able to implement. And so the structure of the industry is really built upon something that said, here are products that we have to sell, and we might have disclosures for these individual products that we have, but all we have to do was to make sure that the product was suitable for the client. We didn't have to make sure that it was in their best financial interest.
And suitability is some sort of lower legal standard than the fiduciary standard.
It is. That's what this is all about. The broker-dealer world still has that structure, and that structure dictates their function, And that means that they have to make sure that what they recommend to clients are suitable for them, not necessarily in their best financial interest.
Oh, interesting.
So, I mean, give us some examples. If a client is basically working with someone that's at one of the larger brokerages and they have their own, brokerage XYZ, mutual fund, targeted mutual small cap fund or whatever, it's their brokerage's fund, and they may have all these fees and stuff built into that, and they're pushing that, and all they really need to meet is some sort of suitability standard.
Correct.
Even though it may not be the best fund for the client.
Right. And so in other words, if you had two different, small cap mutual funds, if you were looking at that, and if you're selling it from a broker-dealer world, right, where you live in this suitability environment, you might say, well, this is a really good performing, investment, and I might believe that that's what's best. Well, maybe you disclose that your firm is getting paid revenue sharing, by that mutual fund industry, but nobody discloses that. Here's all the disclosures. Here's a 30-page thing when you open up your document. Here's the annual disclosure agreement that you get from the brokerage firm. People don't read those things.
Yeah, no, we don't read those.
No, so you've got all that information there, but now, well, what if there's a different small cap mutual fund that doesn't have that revenue sharing agreement, that maybe doesn't have a selling agreement with that brokerage firm? Well, what if that one has just as good as performance, but it's less expensive, right? Well, now I would have to use that fund because it's actually going to be better for the client in the long run than one that maybe is a preferred mutual fund from some fund family for my brokerage firm or something like that. It just gets it gets clouded, right? And it gets so complicated for the individual investor to figure out what's in their best interest. So you want a professional who is obligated to do something in your best interest for you.
Why is it so hard for the individual investor to figure out how much they're paying in fees?
Yeah, it's just, when I was at a brokerage firm, when I started, I think the disclosure was like 40 pages long. I think there was like 8 to 9 to 10 different ways that I got paid. It was hard for me to even keep track of it, and I was a professional in the industry. And so I think there's been a movement afoot, within the last 20 years, and we're seeing more and more of it, to try to break out all those different conflicts of interest and try to have it be much more simple in terms of the approach that you have. So what I find today is that people who are still working in that broker-dealer environment, they're good people, but the way the rules are set up, and this is where it gets more clouded, is that as an advisor in a broker-dealer world, you can have that fiduciary relationship where you got one foot there, and then you cross the line, and you can have it where you're doing commissions too, and then you're going to try to trade information back and forth with the client to tell, well, this time I'm acting like a fiduciary, well, this time I'm acting in a suitability standard. It gets really confusing, and we had the Department of Labor trying to make some of those changes, and then with the administration change, we decided to they put everything on hold for a little bit. And I think what will come out of it is one standard that goes across the industry, but they're not there yet in terms of that. So in the meantime, I think understanding what a fiduciary is and how all these different products work and understanding how the firm is set up, it doesn't mean that you're getting taken advantage of for sure. It just means that it's a little harder, I think, for somebody to always have your best interest at heart when their structure is set up such that they can get paid by commission, such that they can get paid by revenue sharing from mutual fund companies, such that they can get paid, for sales incentives, other things like that. Whereas it might be easier and better just to get all those things out of the equation and not have that structure there, to have a function that really dictates what people do in terms of the fiduciary standard.
But if you're a client and you're just looking at your investment account, quarterly, there's a fee coming out for the fee they're paying, and they're thinking, okay, this is how much I'm paying for my investment advisor, but that's not the whole story. It's what you're
no,
saying.
You've got to look into, you've got to go look and see, well, what are the actual investment costs? What are the costs of those mutual funds that you own, ETFs that you may own? You have to add that cost up, and that gets added to the fee that you're paying an advisor, possibly. You also have to go look at what the filings are, and are there any incentives that company has to promote one mutual fund company over another mutual fund company? It just, it gets super hard to look at that stuff and to figure it out as an investor.
And a lot of that stuff gets basically hidden in the return, right?
It's funny, right? The law says that there's only certain fees that have to be disclosed and other fees that don't have to be disclosed by mutual fund companies, by advisors. And so what's disclosed to the client is what the advisor charges, not necessarily, the mutual fund expense ratios are disclosed through prospectuses. Again, Michael, Do you read your mutual fund prospectus?
No, I do not.
Have you ever run a mutual fund prospectus?
No, they're really long, Scott.
And boring. So you've got to look at those kind of stuff. I think that's why a lot of people, a lot of firms like us, we'll do a complimentary second opinion where we meet with clients all the time, prospective clients, or just, somebody who comes in and wants some help. We don't mind paying it forward. So we'll sit down, we'll explain to them a little bit about what are the fees in their accounts that they have now, and just maybe educate them about what other alternatives are out there for them if they want to make those changes.
So Scott, how does BetterWealth, your firm, charge fees?
Yeah, that's a good question. So we are what's considered a fee-only firm. So we only charge a fee to manage assets and to provide financial planning for clients. We don't accept any revenue sharing. We don't charge any commission products. We don't sell any products that provide us a separate payment outside of the fee that we charge a client.
Like an annuity or life insurance.
That's right. So we will recommend clients, go get life insurance, and we'll help them make that decision. They can go to a life insurance agent that they may work with. They can, go to somebody that we refer them to. It really doesn't matter to us. Our job is to make sure that they have the appropriate amount of life insurance and that they have the right insurance product that best meets their goals, not something that best meets the sales goals of a life insurance firm or a brokerage firm, or not something that meets the sales contest quota for somebody to qualify for something else, or something where they get paid more on to do something else. So we're agnostic in terms of products. What we're really trying to do is to figure out what are the client's goals and how can we help them get to those goals. So
that's a benefit of being independent and not being with a major.
Yeah, and being a fiduciary, being a registered investment advisor. Absolutely. And so, our fees, 100% of our clients pay 1% or less. I think the average across our entire firm is like 0.75 or 0.85. So it really does depend. But if anybody has an account that's $2 million or under, it's 1%. Above $2 million, it's 0.85%. $3 million, 0.75%. And it just goes down from there. So that's in terms of the fees, how it works for us.
And how does that compare to the industry as a whole?
Well, I think the industry average is about 1.25 to 1.5. And then that doesn't include the investment expenses, right? The particular investment. So you're still seeing accounts around 2% all in, as we say. Whereas, most of our accounts are somewhere around 1% or 1.1 when you go all in, when you count in the mutual funds, ETFs.
So we hear a lot about the Robo advisors lately, and these basically, the computer doing your asset allocation stuff for you and buying and selling and that kind of stuff. What kind of fees are associated with those services, and what are the pros and cons of that versus working with yourself? Yeah,
good question. So, if you feel comfortable doing things on your own, that might be a good solution for you. For years, people have worked with Vanguard, right? T. Rowe Price or other kinds of, do-it-yourself. Maybe BlackRock ETFs or something like that, where you feel you can set up your own investment strategy. What I think the Robos do is they make it a little easier for you to do it online. Some of their costs are, I think some of them are 0.5%, some of them are 0.25. I've seen some around 0.15. That's the cost for them to do all the account opening, to do all the rebalancing, to do all of that. That's fine, but that's still not, as what I say, that can be a good resource for somebody who wants to do it yourselfer. But that is still not going to help you figure out what's your goal, what's your retirement plan, how much life insurance do you need, how often should I rebalance? Oh, I need to make some withdrawals coming up, or I've got some extra goals that I want to do. How do I fund those? There's still no trusted advisor. And there are people who need that. And so that's where we come in. We don't have to be right for everybody. Just like there are some people who can do their taxes on their own, right? But that's okay. Right. You're here for the folks who want that professional advice, want that coach.
And how often do you meet with your clients normally?
Yeah, good question. So, normally when we first get started, it's probably 6, 7, 8 times, maybe over a whole year when we're getting started. Once things are set up, we like to do semi-annual reviews with clients. A lot of our clients are local, and even then we're still doing more and more reviews on the phone or through video conferencing, just with some of the Bay Area traffic and other things like that. But essentially, we'll touch in people either on the phone or in person at least 2 to 4 to 5 times a year. So, and I think that that comes back, that earlier conversation we were talking about, why use a financial advisor, or what's the Robo world about, or other things. There's so many other situations in my life where I have a coach, and that coach helps me reach my goals quicker or reach my goals with more confidence that I'm going to get there, whether that's a fitness coach, whether that's a nutrition coach, whether that's a business coach, all those different things. help us. And so that's really, and likewise, when you get somebody tax return done, you're helping them with tax planning. You're helping them with confidence, knowing what they have to do and what they don't have to do around their business, their personal finances. It's the same thing with us around financial planning. What people really want to know is, am I on track to meet my goals? And it's funny, when I interact and have worked with people now for 18 years on this, when people do not reach their financial goals, it's seldom, if ever, because of bad investment performance. When people don't reach their goals, it's fundamentally because they didn't identify what the goal was. They didn't have a plan for that goal. They either then, A, didn't save enough for that goal, or they spent too much money. And so we try to focus on those areas that we can control with clients. Do they have a goal? Is it written down? Are they on track to meet that goal? What are the things they need to do to have retirement eligible for them? We're trying to work on all of those things. Control the things you can control and not worry about the things you can't control.
Yeah, I mean, you mentioned coaching, and one of the primary functions of coaching is provide feedback, right? Provide feedback often to help someone reach their goals. And you're not getting feedback when you're using an automated service, for your taxes or for your asset allocation, that kind of stuff. You're not getting that constant feedback you need to make sure you are on track, because it's all these little things that you do built up over time that really get you to where you want to be. It's not like some magic thing, or, some people, they get lucky and make the jackpot on something or whatever,
Right.
and don't need to worry about it. And then it's about just not losing the money. That's a whole different set of problems,
Yeah, another example I always use is, once in a while I like to go out to a nice dinner with my wife. And when we do that, we generally don't go to McDonald's, right? And when I'm at McDonald's, I'm not looking for somebody to help me with selections of the menu. It's self-service. I can look up there and I can see what I want. I actually don't eat at McDonald's, but I can look at the menu and I can figure it out. But when I go to a nice restaurant, I'm celebrating my anniversary or a birthday or something like that with my wife, I look at the menu, but I'm going to ask the waiter or the waitress, hey, what do you really like? Or what do you think of this dish or that dish? And I'm going to be looking for some consulting back and forth, right? They're going to earn, my trust and my order throughout that menu. And so that's what I'm looking for. And it's just another example of, I'm not going to just retire. I'm not going to have an anniversary every year. Like I'm not going to have retirement every year. I can't screw this up. So having somebody who's a professional coach who can provide me a second opinion, who can really be somebody who thinks differently about things than I do, who does it every day. It's like that great book, I think it was written about Abraham Lincoln, and it was called Team of Rivals. When he assembled his cabinet, he didn't want people who thought just like him all around the table. He wanted people who thought different than him. And likewise, when somebody hires a tax professional, when they hire an investment professional, a legal professional, we're hiring somebody to think different than how we think, who's an expert in the industry, to help us reach our goals quicker and to help us reach our goals with more confidence.
Sounding board.
Yeah.
Right?
Yeah.
We try and act like that for our clients.
Yeah.
So if you look back on your career, now, what are some of the key things you've seen people do over the years to where they end up being successful in the end in terms of, financially secure for their retirement and everything? Like, is there any common themes or traits that you've noticed that have led to that?
Yeah, absolutely. And some of them are pretty straightforward. You have a retirement plan at work. If you have a 401k plan or something like that, you participate in the plan. And you learn to live your life in such a way that you can max out your 401k contribution. That way, if your company has a match with that contribution, you're getting the full match. So, I always tell people, taking advantage of every pre-tax contribution opportunity you have. It's never going to be enough, but it's something that you got to do. Another thing is taking advantage of the Roth IRA if you're eligible for that. There's other ways to do it, even if you're not eligible. Still contributing to a traditional IRA. There are some things the government gives us. They're sort of like, when you're taking exams in school, and it's like the easy one that everybody's going to get the answer right. Participating in the retirement plan at work, contributing to a Roth IRA. Those are the ones you want to check right away to make sure you're doing. The other thing that's really, really important, and I see this as key from people, is that they identified that they had a plan, in the long term that they were going to get to someplace, and they wrote that plan down and they had established goals along the way. They also had somebody who was going to help them. They had a coach, right? If we're trying to get in shape, if we're trying to reach a particular goal, whatever it is, identifying what that goal is. I identify goals on a daily and a weekly and a monthly and a quarterly basis and an annual basis with, personally for me. So we try to have clients do that. So again, it's taking advantage of all those pre-tax opportunities you have, taking advantage of the Roth IRA, having a plan, getting a coach. And then the other thing, lots of times we'll talk about is just trying to look at situations and understand what you can control and what you can't control, especially with the financial media and what happens in the markets and everything. There's so many things we can't control, but there are some things we can control. So we always try to get people to focus on what are the things you can control. You can control, is your plan written down? Are you contributing to your plan every year? Are you contributing enough? Are you properly, have the proper asset allocation for what your time horizon is? That's a really big one. Are you rebalancing your portfolio on an annual or semi-annual basis? Those are the kinds of things that what we've seen when people who reach those successful goals or reach that end prize of being retired really have done well. And then the last one is just sort of, everybody has their own relationship with money, but I think fundamentally understanding that you can't outspend what you just can't outspend. So understanding what a budget is and then being able to live within that budget. So that's huge.
Yeah, I mean, it seems like such a basic concept, yet so few people, I think, adhere to it. I wish there was a little more financial literacy in the world, and it was more focused on in school, at all levels, starting from being a kid all the way up until you get through college. And really, a lot of people get through school and never take any classes really on financial basics or accounting or just like balancing your own frickin' checkbook and that kind of stuff.
Yeah, why are we not teaching that in high school? It's amazing.
And technology, in some ways, technology has not been has helped us in this area specifically. Like I remember when I got my first job, and sort of later in high school, and back then, right, you didn't have debit cards, so you got your paycheck, and you took your paycheck to the bank, and you cashed your paycheck, and you got cash, and you put your cash in your wallet, right? And so I was doing that, and then as I was, graduating and getting out of college, my dad sat me down one time and said, "Okay, this is how it's going to work. You get your paycheck, and you cash it." And I've got all these envelopes that he wrote out for me. And in one of the envelopes, he wrote rent, And he said, "Now, how much do you need? How many times you can pay this month?" And we took the amount of cash that I needed from like one paycheck or two paychecks, and we put it in, and I needed, $200 for rent. So we put $200 on an envelope, and we put $200 in there. And we did the same thing for gas, same thing for utilities. We didn't have cell phones. Same thing for, food, same thing for going to movies, and we had these different envelopes, right? And then as the month went on, if I ran out of money in my entertainment envelope, I didn't have any more money in my gas envelope. My utilities were already paid. So I was going to have to go take money from my rent envelope, to go have some fun. It made me stop and think, whoa, do I want to take money from rent to go to a movie tonight? How am I going to pay that rent next month? And so it was a little easier sometimes when we had cash because we learned those tricks, right? And I still remember that lesson from my dad teaching me about having a budget. And my wife and I, we don't do things by cash anymore, but we still have a budget, and we still know what that is every month. And we look at it and we sort of say, were we in budget or over budget this month?
Yeah,
so,
Mint really helps track that now. I get those emails halfway through the month. Your entertainment is nearing the budget, and so then we have to scale back on entertainment.
Yeah, there's actually one called envelopes.
Oh, okay. So going with your cash envelopes.
Yeah. And we did a little blog about what are the different ways, what are the technology tools that you can use to help you, like mint.com, yodely.com. There's lots of other ones out there. But fundamentally, learning to live on less than you make, right, after you do all your saving and everything else is one of the key things to having a successful retirement.
Yeah, that definitely makes sense. I wanted to touch on a couple of things that I've heard you talk about in the past, and you had made some references to thoughts on like financial media and what we hear in the news and how should that affect our investing.
Yeah, and what I always try to say is, you can read the financial news for entertainment, not for an investment strategy.
Okay.
Right? So you really want to ignore the financial media because the financial media is much more about, it's a business for them. And their business is all about getting people to listen. And so they're going to, be as sensational as they can be to get you to buy the magazine, read the article, click on the link, whatever it may be. And that's not necessarily in your best interests. And so that financial media is not there just to disseminate information or what's happening with the market. It's there to really sell advertising so that they can have a profitable business. And so just, always take it with a grain of salt. And remember that what you really want to do is you want to have a plan, right? You want to have a plan. You want to have a coach, right? You want to be able to know what your goals are. You want to be able to live within your budget. And you just want to be on track, knowing that you're on track for those things. And the financial media is not always going to help you do that.
Yeah, that makes a lot of sense. How about timing of the market? Should I be saving a bunch of money and then wait for like a big dip in the stock market before I invest?
Yeah, that's a good question. So timing the market is academically been proven, right, in research to not be, your odds of success are very, very low. So I think the best strategy, and they've looked at this, right? Because when you try to time the market, because most people, what you said, Michael, was, is there a good time to invest? Well, yes, there's always a good time to invest. But the bigger thing about timing the market is people want to get out when it's a bad time, right? More so what you end up having people do. And it doesn't work. They've done studies after studies after studies around this, and it's been clearly proven that the ability to be able to time it right on the exit and then get it right the second time on the entrance when you go back in, it just doesn't work. So I think you're better off, really having what a set plan is, contributing regularly to like your 401k, contributing regularly to an IRA, contributing regularly to an investment account. That doesn't mean you invest all your money every month. I save up money, right, over time. And then when I do see a market correction, I figure everything's on sale and it's a good time to invest some of my money, not necessarily all of my money, right? So you can definitely take advantage of that. And sometimes we would used to say, whenever you see the market drop 10%, that's a good time to add money to your portfolio. Not all of your money, but some of your money.
Well, if you're financially disciplined, which is like some of the stuff we were talking about earlier, and you're always making sure you are building up and having a healthy surplus of savings and cash, dry powder basically, and that kind of stuff, then you can take advantage of those opportunities when they do come along, right? When there is a 2008, 2009 or something, if you're able to have some extra to put in as a tanking, look how well people have made out by doing that. And you don't know when the bottom is going to be. You can't, catch the falling knife, quote unquote. But if you have that liquidity available and you're being financially disciplined the whole time, then you are going to be able to take advantage of some of the things as they pop up. Or, one of your friends or someone comes to you with an investment opportunity that actually pencils out to be really good after you're doing your due diligence and everything, you don't want to be in a situation where like, oh, I can't right now, I don't have the cash, but if you did and you can invest in it, you're going to hopefully do well if it's a good investment, right?
You are. And there's a great quote from Warren Buffett: when people are fearful, I'm greedy. And when people are greedy, I'm fearful. Right? And so the idea is don't follow the crowd, right? Step back. There was another one when I first started in my career. I got a brick. The company gave me a brick, and on the brick it had the numbers 1 and 4. So 1 and 4. And I had it on my desk, and they said whenever a client came in, they're going to ask you, what's that brick for? And it says, why does it say 1 and 4? And the idea is well, when you invest with me, you can expect your account value to be down 1 in 4 years. And when it does, you're going to feel like throwing a brick through my window. So just remember, when you throw that brick through the window, wrap a check around it, because that's the time to invest, right? So when you look at your statement and you're like, oh, it went down, maybe that's a good time to invest. Kind of the idea behind that.
We've also talked in the past about risk tolerance and what the correct risk tolerance is. Can you speak to risk tolerance for your individual clients?
Yeah, risk tolerance, getting back on that Robo topic, right? If you're just online filling out a questionnaire, and that's traditionally what people think when they think about a risk tolerance questionnaire, I need to fill this out. Well, risk tolerance is not just a questionnaire. It's much more than a questionnaire. A questionnaire can be one tool part of it, but really it's sitting down and understanding, well, first, what's the time horizon? That's the number one thing you want to look at. Second is, what's your own experience? What's your gut check? How have you, operated with your investments in the past when things have been good, when things have been bad? It's like going on a cruise or going to a buffet where you can eat all you want. Right? Everything's right there. Does that mean you eat everything? No, you still want to, have some sort of resistance to understand what's good for you and what's not good for you. And so what we try to do is really sit down with each client and figure out what their risk tolerance should be for each goal. You're going to have a risk tolerance that we're going to set up for your retirement, one for maybe college savings, one for maybe a vacation home purchase, one for maybe something else. That's what we call goals-based financial planning. And I think that's something that's really been in the, in academic research, we're seeing more of it about the last 5, maybe 10 years. And I think you're going to see more and more of it in the future. We really have a goals-based approach to all the financial planning so that every goal has its own portfolio. And every goal, is tracking to that time horizon, to that risk tolerance that you have. So understanding your risk tolerance is absolutely critical to achieving your goals. It's just not something that one questionnaire can answer for you. It's sitting down and having a conversation and really working through many different variables to say, okay, and then it's talking about, well, here's what some expected returns might be like, positive and negative. What can you deal with? How have you dealt with that in the past? And then figuring out what's palatable for you in terms of being able to reach your goal, but also make sure that you're going to stay on track, that you're not going to bail out halfway through the journey because there's too much volatility in the portfolio.
Sure.
And shouldn't the allocation really be more about how close you are to that goal and shifting more towards less volatility and that kind of stuff as you get closer, so the portfolio's swinging, upwards and downwards and upwards less, right? So it's a little more smooth near the end, not so much based on what you personally, emotionally feel, because what you should really be doing is maintaining that financial discipline, just keeping your head down and not listening to the financial media, not looking at your account statement all the time, except, at the updates you're doing with your coach to kind of check in, make sure you're on track, and just kind of stay the course. That's really the important part.
It is, and in a perfect world, that's what happens, right? And maybe that happens, maybe I experience maybe 60% of the time, but then you have other clients where 40% of the time, they just, it was very common back in 2009, right, when the market was down, the S&P 500 was down 50%. In March 2009, we bottomed out. People were just like, I can't take it anymore. I can't take it. And so we had to figure out a way to not have them abandon ship. And so even though you might say, well, I'm not going to use these funds, for 20 years or for 15 years, therefore I can be, 80% stocks and 20% bonds or even 100% stocks, right? Some people can't actually stick to that plan. And so it's really, even though they know what's best, they're still going to have a second helping of dessert if it's available. And so it's a matter of sort of saying, okay, well, how do we have something that's still going to reach your goals? I think ultimately that my job as a financial advisor is to make sure that we're taking the least amount of risk to sort of meet those needs, right? That's the idea, is how can we reach those goals and take the least amount of risk to still get us there? And that's the idea.
Try to minimize the downsides, right?
Yeah.
You want to try to limit as much as possible.
As you're getting closer and closer to that goal, you should be getting more and more conservative in the portfolio. Absolutely.
That makes sense. Matt and I have been talking a lot about tax changes and wanted to see how that is impacting your investment strategies.
Yeah, there's been some big tax law changes. And I think fundamentally what we've seen around that is just the whole idea that the more cash in the markets, right? With the tax reductions for corporations, for individuals as well. Just, the example I always tell clients, you need more cash in pockets, and generally when that money is in the pockets, you're going to spend it, whether it's a corporation doing buybacks, whether it's a corporation hiring employees. All those things sort of work out to be good for equities, if you will. And so we're expecting that the markets are going to continue to do well. That doesn't mean that there aren't going to be normal corrections along the way. The markets, the economic cycle is always a cycle of expansion and contraction, expansion and contraction. We've been expanding for quite some time. We think that expansion is going to continue, but there will be a correction, right? It will contract. Nobody has a crystal ball to know when that is. I think fundamentally those tax law changes are going to, sort of help the economy, at least in the short term of the next 1 to 3 years. There's just going to be a lot of cash coming back, especially when you look at all these larger companies bringing back all that overseas money, right? And it's just going to, you're seeing the expansion, the hiring of jobs, all those things are going to be good for the economy. So that's number one thing we're seeing. In terms of, is there a specific change to people's investment strategy or portfolios? No, we haven't seen anything specific around that. We've still seen people just wanting to understand it's normal for the market to go through corrections. We always say a dip. When the market dips, it's generally going down about 5 to 9%. That should happen on average about 3 to 4 times a year. That's the normal, frequency of when we have a dip, 5 to 9%. We haven't been accustomed to that for 5 years almost, it seems like. We're getting back into that this year, I think, in terms of some of the volatility.
Yeah, we're definitely seeing a lot more volatility.
And, a correction. When the market goes down 10 to 19%, we typically call that a correction. That happens about once a year. We had one just a couple months ago in January. Prior to that, we didn't have one for 2 years. Last one before that was January of 2016. And then before that, it was August 2015. And then before that, it was like 4 years without a correction. Very unusual times. And when the market goes down 20% or more, we call that a bear market. And that happens on average about every 3 to 4 years. And it's been about 8 to 9 years since that's happened. So I'm just telling my clients that I think we're going to continue upon this, economic expansion in the near term. But, there's a correction coming, right? We always have one coming. There's a bear market coming. And that doesn't mean that you're going to change your goals. It means you might invest some money if you have some extra money available. But it doesn't mean you're going to abandon your goals.
What about some of the more looming macro issues or threats? The national debt is one thing that kind of, tends to concern me as an accountant. I look at that balance sheet and I don't like seeing a lot in the liability section. Is that a concern? It's got to be a concern. The interest is just, on that debt's massive.
Yeah, I think on some of these bigger, issues, what I always try to tell people is those are issues, we've got to deal with those issues. We've got bigger issues than that in terms of Social Security, bigger issues, frankly, in that in terms of healthcare, right, and how we're going to challenge those things. But fundamentally, what we're investing in is capital markets and how capital markets work. And I like to talk about it in terms of capital markets because it's really how we want to use our capital. And so we might have issues and concerns longer term about debt. We might have interest or concerns longer term about interest rates, about, war, right? About all these different things. But fundamentally, what we're investing in with clients is capital markets. And capital markets don't stop working in those environments. They still work. People are still going to the store, buying groceries, still buying toilet paper, toothpaste, napkins, whatever it may be. Businesses are still out there purchasing goods for the services they provide. And all those things are still working. So fundamentally, what the stock market reacts to is the ability for companies to make that capital and turn a profit with it. And that's what really drives things in the long run. So there's, if you go back and you look at time and you go back to the early 1900s and you just sort of look at the markets going through all that time, there's always been huge concerns, big, social economic issues that people have been concerned about. And yet the market has continued to grow. So the choice is, do you leave your money in cash under your bed, right? Do you leave it in CDs?
Oh, gold buried in the backyard.
Yeah, gold, things like that. You don't want to do that, right? You have to trust that capital markets work, and they're going to continue to work, and that's what we're really investing in. So, and another good quote from Warren Buffett was that capitalism works. It doesn't work for everybody, right? It's not like as if we have equality all the way across the economic markets, but capital markets work, and that's something you don't want to bet against.
Long term, yeah.
Long term. Hey, there's a couple other things that I wanted to get your sort of perspective on that I was thinking about. You guys are asking about retirement and how do people know when they should be retired and some other things like that. And what I'm beginning to see in a lot of our academic research is that retirement is changing. And I don't mean it's changing in the next 5 years or 10 years, but when we look out over some of the advances that are happening, we're really expecting longevity to increase. And we're seeing that it's not going to be like our dad's retirement. I don't think your retirement is going to be like our parents' retirement where they stopped working, they worked one job, maybe 2 jobs, and they took their pension and then you had 40 years in retirement or 30 years in retirement.
Right.
I'm seeing more and more things where people are going to have mini retirements, where they're going to retire for a little bit, retool, if you will, go back to work in a different kind of career or do some other kind of part-time work. We hear about that gig economy. We hear other things like that. I was at a conference recently where they were sort of saying that beginning in 2029, your longevity is going to increase 1 year for every year that you're alive. And the technology, healthcare technology is just going to really get that longevity out there that you're going to see people with this sort of expanding retirement of different jobs. That's what we're trying to help.
Yeah, I agree that what retirement is definitely changing. I'm seeing that with my clients get to that point, and that we're doing some tax strategy stuff around that too, because a lot of these, clients are in their, late 50s to early 60s. they're getting ready. They want to work as hard as they've been working. They want to slow down for sure and start to enjoy things in life a little bit. They also don't want to stop working completely and be bored. So they kind of want something in the middle. And they have a skill set, really valuable. They have the gray hair. They have a lot of the wisdom. And so, part of our strategy is, why don't you look into retiring from your job and coming back on by that company or a couple companies, a more of a consultant type role, because we got this new pass-through deduction thing. And if you keep your income under certain limits, which they're likely to be if they're working in more of a part-time capacity, they can get this 20% pass-through deduction thing. We actually they're working out of their home, so you can take the home office deduction. That gets us around a little bit of the $10,000 cap on the state and local property taxes now. We can write off some of the other costs they're incurring towards the business. We can still set up a little bit of retirement planning stuff while you're continuing to work and sheltering some income from tax. And so you're still making income. You're still working a little bit, but you're being way more tax efficient about it than you are when you're a really high income earning employee. You don't really have a lot of options in terms of write-offs. So I think it's kind of like an interesting side impact of this new tax law is it actually lends itself even more to some of that, consulting type work where you're on your own, taking the pass-through deduction and keeping your income low enough you can be tax efficient for a long time. The hardest part's the healthcare, though. I'm seeing, what are you going to do about the healthcare?
And I can't imagine an individual trying to figure that out on their own. I just, all those things that you just rattled off.
Listen to our podcast.
Well, listen to your podcast, but I'm going to just say, hire a professional. Hire somebody who can coach you through that sort of different stages of retirement and how to take advantage of those kinds of things and how to do it tax-wise, right? I think that's just great.
And actually, I think there's going to be a lot of health benefits to continuing to work and having that purpose. I mean, studies have found that people that have purpose live a lot longer. So
yeah, I remember all the stories of somebody retires and they die like a year later, right?
Yeah, they're like, now what?
Yeah, now what? And so, yeah, we're seeing that too. We're seeing that to where if you stay engaged with the work and you enjoy the work, right? Now, if you got a 9-to-5 job that you just hate, well, get out, right? But that's not worth it. But if you enjoy the work and you can contribute, all that adds to a more enriching retirement, a more enriching life, which is what we're all about too.
Yeah, I mean, you see it on, we see it, I think, but I'm sure you see it also that certain personality types of clients they tend to live a little bit, longer, or they're healthier and doing better as they get older because they're still to some extent driven and doing stuff and staying active and moving around and not just kind of sitting there, fading away.
Yeah, I say those things, and I also say yoga. Even though I don't really do yoga myself, for whatever reason, I see these clients and they're just in phenomenal health at 85. They're happy. They're just doing great. And I'm like, what did you do? And, invariably a theme has been yoga, for these people.
So after our listeners listen to this podcast, what they're going to take away from it is I will do yoga to live longer.
And work part-time as a consultant.
That's right.
There you go.
All those good things. Yeah.
You guys have anything else you want to cover? We're at cut all this part out, obviously.
I would say, so that's a good point about yoga. I think there's something else that I've started talking to clients a little bit about. And this goes back to the financial media. When you have that stress coming to you, I think we need to, or when the market corrects, I think we need to understand that there are some things we can't control. We talked about that. But there are also some things that we can do that are positive. And so I've been talking a lot with clients about some positive addictions that I think people should do. And some of those are exercise, right? Doing some sort of exercise. It doesn't have to be super high intensity or anything else. Another one is going to work, right? Going to work and sort of, rolling up the sleeves and sort of ignoring what's going on around you and getting your job done. Another one that you can really do is solitude, I think, taking some time to be with yourself a little bit. And then the other one is really quality relationships. So when clients have asked me at different times, what should I do about the financial media? What should I do about some of these other things? I'll start talking to them about practicing some positive addictions. And those might be some things to think about too.
Oh, that's great advice.
I mean, those are things your whole life, right?
Yeah.
So you should be trying to take advantage of that kind of stuff. I mean, you feel so much better when you're working out and staying healthy, right? I mean, we joke about tax season or busy season kind of being rough and hard and that kind of stuff. But actually, I love tax season. When I'm in it, the day goes by so fast before I know it's 5 o'clock because I've just been busy in it, working hard the whole time. So you don't even realize how quickly it goes by, right? And then, time to reflect. Solitude, I think, is important to reflect back. And that's part of writing down your goals is then writing them down, then seeing how they compare to the actual outcome, and then reflecting on that a little bit and thinking, about why and why not, what worked, what didn't work, right? In an objective manner, you don't beat yourself up about it if it didn't work out, right? You just try and figure out what didn't work and why, and then try and correct and do better the next time if that's what's required, or if it's on track, think about why it's on track, and was it because of the way you thought it was, or was it something else? But you use those opportunities for reflection to look back and then adjust your goals, right? And that's hugely important. It's hard to find that time when you have 3 small kids, but you got to find a way sometimes,
Good. Hey, well, it's been a real pleasure to be on the podcast with you, fine gentlemen, and hope it was of value to your listeners.
Yeah, absolutely. Thanks so much, Scott, for being on. That's all for today's episode of Debit This, Credit That podcast. As always, if you have questions, you can contact your Wheeler Accountants Preparer or submit a question online at our website in the Ask Wheeler section at the bottom of the page. Please remember to follow us on social media for regular updates at Wheeler CPAs and on LinkedIn and Facebook. Thanks for listening as we help you solve for accounting.